This is Impact Footwear and our BSG analysis, featuring co-managers Josh Evans, Ashley Federoff, and myself, Stephen Hunter. At Impact Footwear, we believe that if you look good, you'll perform good. We offer high-quality athletic footwear designed for any sport enthusiast striving to be their best. We're a global leader in quality and cost per quality rating, with a mission and vision focusing on providing a product best in quality, durable, and providing superior comfort and performance. We also want to achieve most desired product throughout the footwear industry. We have large production facilities and have been able to expand into all 4 regional markets, including North America, Europe, Africa, Asia Pacific, and Latin America. One of our largest accomplishments has been our ability to also control and contribute to the private label market in all of these regions, expanding throughout the years and leveraging these markets while maintaining strong internet and wholesale transactions. We've also had the opportunity to expand into all of our facilities while being strategic and competitive by continuing to monitor and benchmark our other competitors as they also attempt to increase their quality of shoe produced. Impact Footwear has continued to commit to the industry by providing high quality shoes at competitive prices. Our trends have demonstrated our success in meeting and exceeding our goals to reduce our payments of high import taxes, incrementally increase our quality star ratings, and our shares in all of our markets. We've also been able to control private label productions to drive costs and optimize our overall profits. At the close of our game in year 18, we ranked highest in investor expectations with a top best in industry score reflecting highest earnings per share at $19.26, a 45.5% return on equity, stock price share of $462.80, and continued top performance of credit and image ratings throughout the preceding 10 years. We have exceeded production and performance benchmarks while maintaining industry trends compared to our competitors, and our continued long-term growth trends are projected to be positive as well. Overall, Impact Footwear continues to be a leader in the industry, maintaining competitive forces based off our business strategy in the coming years. Our developed mission is to deliver our global customers a desirable and authentic footwear product with excellent performance attributes by including quality, durability, and comfort in a variety of options to suit your lifestyle. Our vision statement is to be the most desirable product and most sustainable athletic footwear company worldwide, being a benchmark in the industry with an admired brand, superior quality and comfort, allowing every athlete to reach their highest potential. We believe that anybody can be an athlete. Initially, when the other firms in the industry began the simulation, it appeared that everyone was attempting to pursue a differentiation strategy. Some succeeded in this strategy, while others had remained somewhat unsuccessful. Over the duration of the first 2 years, the market became very competitive, and firms subsequently changed strategy in order to gain the most market share. Impact Footwear stood strong despite a year of fault, and this led to opportunities to identify our strengths, weaknesses, other variable opportunities, and subsequent threats. As firms began to change their strategies, it opened the door for threat of new entrants, which required others to consider effective strategies for deterrence, leading to drive increased spending in markets to continue to satisfy existing customers and maintain their consumer resources. For our firm to continue to remain competitive, we chose to maintain a broad differentiation strategy aimed at keeping the highest S&Q rating overall comparative with competitive costs. This was able to allow us to maintain cost-effective operating costs as well within all production market niche. Due to competition, there was also a high threat of substitutes from the different companies. Company D had been our closest competitor overall, which highlighted our need for us to continue to propel forward without wasteful endorsement, limited involvement in corporate social responsibility measures, and allowing us to choose to further invest into private label operations. This allowed us to increase our utilization of higher S&Q rating opportunities, expand into other global regions early, and also integrate our other facilities, allowing our company to surpass expectations and other competitors while still being able to continue to produce a product favored by demographics with high quality and competitive prices. It was also crucial for our company to maintain line of sight in upcoming changes throughout the years. This particularly focused on adjusting cost of materials. Given our high S&Q ratings, our materials that we utilized were desired to maintain quality and again, compare costs to other customers or competitors in the industry. Our consumers had the ability to transition to another company at any time, depending upon their satisfaction, which was an opportunity that gave us most benefit. We continue to monitor trends and position ourselves competitively within the internet and wholesale markets, while still being able to control the majority of the private label markets and operations over the years. This demonstrated much success and also allowed further opportunities to develop for impact footwear. Rivalry also developed among the existing firms in the market and was one of the competitive forces that affected our company and industry. Identifying this had been important since the beginning of the simulation, as each company was also trying to make great efforts in their strategy to gain largest market shares. Within our firm, another threat that was identified for us was continuing to increase our S&Q rating exponentially above others to maintain a competitive edge with rising sale costs for consumers. Withstanding our broad differentiation strategy allowed us to continue to increase our ROE, EPS, and shareholder value. We were able to gain market share and continue to remain competitive over the years with our increased costs and our S&Q ratings. We also focused on the impact of tariffs and exchange rate costs, which can produce threats for domestic competition, including government regulations, and also advances in the product to be further developed. This allowed us to also produce and identify further strengths as well as opportunities for the coming years and in the future for the industry and impact footwear.
Here at Impact Footwear, during the year, from year 11 to 18, we had to make several different decisions, and several of the decisions end up being the same for each year. During the first year 11 to year 14, we were seeking to find a niche market and where we would really be able to shine. We knew it from the start that we wanted to offer a top-notch product. However, it was going to be trying to separate ourselves from the rest of the market in order to form the best niche. Once we were able to find the niche in the higher quality and quantity market, we tried to take advantage of this market with more money being spent on advertising periodically, which was during year 15 and 17 for us. The company chose that each year we would attempt to compete heavily within the private sector market, which we were very successful in all years except for 12, which 12 was a rough year for us as we were still trying to find out where we wanted to compete and how to compete, we were going to compete. The company chose that each year that we would stay away from celebrity endorsement, focusing largely on building a strong image rating from year 11. We kept our image rating up in the upper 80s to 90s range the entire time. We came in from the start and continued each year with buying back as many stocks as we could afford each year, helping raise our stock price. And we ultimately took out loans early in order to expand and buy new equipment in order to help the quality. We were able to repay back those loans each year with refinancing almost every year that had a better financing rate for us. And that helped us in order to expand and build into these other facilities. As we can see, we had a continued upslope on almost all our projections, except for year 12 being more of a plateau down year for us. That includes for our EPS, revenue, return, and credit rating. As we see, our stock price continually climbed. That was with also the repurchase of stock during that time, which you can see the image rating stayed between that 80 to 90 range most of the time. It stuck around that 89 range for us. Our biggest competition, as we mentioned a little earlier, was Company D, Soul Searchers. They had the second highest quality product. They spent more money in advertising in the early stages and was having celebrity endorsements throughout. What they ended up having several competitors fighting for their niche market with us above them and A and C right below them. Once we came later in the years, we were able to separate ourselves higher in the quality and quantity market, which left no competition for us in the later stages. And with advertising and price becoming the main focus for us, we were able to kind of dictate where we wanted to go with our niche market and how much, we wanted to spend in those markets.
A company's business strategy asks how one should compete or cooperate within the industry. At Impact Footwear, our competitive business strategy was focused on a broad differentiation type throughout the simulation game. Differentiation in this form allowed us to provide unique and superior value to the buyer, including a quality product with special features. Our focus ultimately was to provide a product different from our competitors by offering superior attributes appealing to athletes. The athletic footwear market, as mentioned, is that of a niche market. However, we were able to demonstrate customized attributes to meet customer needs and preferences over the competition for a larger clientele. Utilizing our differentiation strategy within both domestic and international markets was aimed at an overall broad and global mass market involving the creation of a product to be perceived within the industry as having sustained elements of VRIO, which was both effective and successful for us. We were able to charge a premium price due to our high quality in all of our markets. Differentiation differentiating it with earnings above average in return. By doing this in this manner, it allowed us for distinctive proficiency to compete successfully in all the markets compared to our competitors. Within this continued strategy throughout the years of our simulation, we constructed new space in our Europe, Africa facility early on and entered the private label operations throughout. In addition, we revised our layouts and performed to reduce production setup costs within our domestic North America market and international Asia Pacific facilities. Decisions surrounding the differentiation strategy allowed us to have the lowest cost per S&Q rating in the industry, and we also focused on search engine advertising primarily in the internet segments for all of the markets. Specifically within year 13, advertising in North America, Europe, Africa, Asia Pacific, and Latin America was 30.3%, 33.3%, 11.1%, and 49% respectively, compared to all overall industry averages. Focusing on this broad differentiation strategy throughout, jointly with our performance targets, allowed Impact Footwear to provide this unique and superior quality product to athletes with value, surpassing our competitors, again leading to higher ROE and EPS.
Here at Impact Footwear, we decided early that we were not going to be super active with the corporate social responsibility. During years 11 through 16, instead of investing in corporate social responsibility, we chose to expand our plants and buy back stock early in order to be able to produce more shoes. Once we entered into year 17, we had an excess amount of funds, so we invested into energy efficiency initiatives and improved working conditions, which continued into year 18 for us.
When determining our performance targets for years 19 and 20, we decided we wanted to continue with the strategy of offering the highest quality shoe for competitive prices and also continue the focus on the internet and private label markets. As mentioned previously, we did really well in year 11, had a downward spiral in year 12, and then continued to do really well years 13 through 18. So again, we just continued on that trend. When determining the targets for years 19 and 20, all we did was average what our increase was over those successful years and just continued them on for the next 2 years. So it took our earnings per share up to $22.03 in year 19, and then $24.80 in year 20. Again, same thing, the return on average equity just increased a little bit over years 19 and 20. And again, stock price would continue to rise as our strategy was to buy back those stocks from the beginning. Our credit rating had remained an A+ for the last several years, so we predict that it would stay the same over years 19 and 20. And then same with our image rating. We were in the high 80s and 90s throughout the game after year 12. So we predicted that our image rating would go from 90 and then 91 in years 19 and 20. The market share targets were a little more difficult to project over years 19 and 20 because we were kind of really all over the place depending on the year and what that focus was that year. So rather than averaging them out, kind of just looked at the trend over the last couple of years and then determined our targets from there. So again, we kind of used the same prediction for years 19 and 20 throughout each region and each segment. However, continuing to focus our private label segment where we predicted and achieved close to 50% every year. So again, in each of the regions, that prediction would remain at 50%. So company success, you know, throughout the years, we conducted an analysis every single year on our performance as well as the other company's performance. As mentioned in the SWOT analysis, we looked at all of those areas, but also using the VRIO framework to determine where our position was in the market and making any necessary changes that we needed to. So as far as value, we did determine that our product was valuable. It was rare in the fact that it was the highest quality and offering it for a price that was fair given the quality. And as far as imitating it, again, we were far above the rest of the companies as far as the quality of our shoe. So we determined that the other companies would not be able to imitate the shoe based on that factor. Along with an analysis to make sure you stay ahead in the market, your customers and employees should be focused for managers. It's important to pay your employees fair wages, care about them, and treat them as if they are part of your team and you are a part of their team, not that you are above them. Recognizing and rewarding excellence in a team is key for managers. It keeps employees happy, which means it keeps them working for you. Things that customer or manager should not do is, again, act as if they're not part of the team with their employees or overwork their employees. Also, as far as customers, you never want to cut the quality just to save a couple dollars. Impact Footwear, we did spend a little bit more money to keep the quality of our shoe up. However, it did bring in more customers. And as far as customer needs, you always want to take their feedback and, you know, analyze what they're looking for, make changes based on that feedback. Lessons learned. We talked several times throughout this presentation that our biggest lesson learned was going from year 11 to year 12. We had a really great year in year 11 and thought we had the right strategy. However, we determined that offering the highest quality shoe for the lowest overall price was not that winning strategy. We needed to increase that price to make it fair still, but not overpriced. And going into the future, one of the areas that we thought we could improve on was growing our facilities in other regions. Again, we performed very well through years 13 to 18. So we didn't feel like we really needed to make many changes. So again, continuing to analyze the performance of our company as well as the other companies into the future and make necessary changes.